Welcome everyone, happy November. Thank you so much for taking the time to join today's webinar. It is top of the hour and I do want to be respectful of everyone's time, so let's go ahead and get started. I'm Reneika Lightbourne and I'm delighted to have the one and only Kaylee McMahon, also known as the Apartment Queen. She's a founder, a general partner, a key principal with nearly 70+ million under assets under her management. And today we're going to talk about, or she's going to cover how real estate investing through crowdfunding works, kind of give us the different rules and regulations when it comes to crowdfunding. But before I hand it over to Kaylee, I just want to kind of give you a quick synopsis of what self-direction is and some of the options available to you in terms of the account types. And then, of course, once you're ready to get started with us. If you have questions, put those in the question box and we'll allocate time at the very end to get those answered for you. So my name is Reneika Lightbourne. I'm one of the business development specialists with Advanta since 2019. I'm also an Advanta client since 2017 or so. So self-direction is something that I actively do myself. If you have specific questions or you want to kind of do a one-on-one consultation, you're welcome to reach out to me via email or give me a call or visit us at advantaira.com to schedule that consultation. So just a little housekeeping before we get started. Just know that Advanta IRA and its employees, we don't give any tax, legal, or investment advice. We also don't endorse any particular products. All of the information that's going to be presented today is just more so educational purposes. So with any investment, we always encourage you to do your due diligence. You want to consult with your attorneys, your CPAs, financial advisors before making any investments. So just quick takeaways, just know that any IRA or former employer plan qualifies to be self-directed. When it comes to self-directing, you're always in control, so you choose the investment that works best for you. Today, Kaylee's going to focus on real estate, so if that's your forte, just know that you can use IRA funds to invest in real estate-related assets. And then, of course, all of the income that's generated from that investment flows back into your retirement account. If there's any expenses associated with that investment, it's going to be paid out of the IRA account. So a little history about Advanta and who we are. We've been in business for about 20 years now as the leading self-directed IRA administrator in the business. Our headquarters is in Largo, Florida. Advanta has an office in Atlanta, which is where I'm based. But we do work with clients nationwide. We have a little over $2 billion under our administration. While we don't give our clients any tax, legal, or investment advice, our team is comprised of attorneys and also certified IRA service professionals. Just know that if you have cash sitting in your account with us, it is FDIC insured. And then, of course, for us, we kind of differentiate or separate ourselves by providing our clients that concierge style service, meaning as a client, you have a dedicated account manager that's going to be with you for the life of your account with us. And then, of course, our educational content is second to none, where we have experts and guest practitioners like Kaylee that comes in and knowledge share with you. Just know that this webinar is going to be recorded. It is recorded. It will be uploaded onto our YouTube channel within 24 to 48 hours. We also host other networking events such as Pitch, Promote, Prosper. It's every other Friday. Visit our website, check out our events page to sign up. My colleague Alex also has a podcast with great content. Anything and everything relating to self-direction you can also find on our blogs. So just really quickly in terms of what is a self-directed IRA? Very simply, a self-directed IRA just means that you as the account owner, you're going to have complete control over your retirement funds. You have complete control over the investment decisions. You get to use it to really diversify out of the traditional stocks and bonds. We have clients that use IRA funds to invest in the likes of real estate that we're going to be talking about today, like multifamily or commercial. You can also use it to invest in, fix and flip or rental property, tax liens, notes and mortgages, precious metals, oil and gas. The list goes on and on in terms of what's on the table for you to use those qualified retirement funds to invest in. And then, of course, a question that typically comes up is, why do people choose to self-direct? You may look to self-direct for many different reasons, and I'll just touch on three. One, it can be a new source of capital for you. So instead of tapping into, your personal savings or taking out a bank loan, if you have funds that's in an old 401k or an existing IRA, instead you can elect to move those funds over to be able to make your next investment. Two, the ups and downs in the stock market. No one really, have any control over, whether it goes up or down. But a lot of clients that self-direct, specifically, into real estate, they know real estate is a tangible asset that's always going to retain its value. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the ones that you're already familiar with. For individuals, whether it's a traditional IRA or a Roth IRA. With traditional, you get a tax break up front. You pay taxes later when you reach retirement age of 59 and a half and you start to take funds out. With a Roth IRA, however, it's post-tax dollars, after-tax dollars. You've elected to pay those taxes up front, grow that account over time. Once you reach retirement age and you take those funds out, as long as you've had that Roth account for 5 years, it's tax-free. If you are a business owner, entrepreneur, have a side business, you can look to self-direct what's called a SEP, simple or solo 401k. A lot of real estate investors like yourself on this call, particularly like the individual 401k because you have greater flexibility. Some smaller accounts that can also be self-directed are educational savings account and also HSA to cover medical related expenses. With HSAs, though, just do know that you have to have a high deductible plan. So you want to check with your plan provider just to make sure that you're eligible. And then, of course, any former employer plan qualifies, whether it's an old 401k, 403b, or a TSP type plan that can be self-directed. My phone's ringing in the middle of the webinar, so my apologies for that. In terms of the contributions for 2022, I'll also cover 2023 as well, just because we got those updated numbers. So you can fund your account by making a contribution as long as you have earned income. For a traditional Roth IRA for 2022, you can put in $6,000 if you're under the age of 50, $7,000 if you're over the age of 50. With 2023, we're going to see it increase just a little, so you can put in a total of $6,500 if you're under the age of 50, an additional $1,000 if you're over 50 for 2023. With SEP IRAs, you can contribute 25% of your earned income. For 2022, it's at $61,000, but next year for 2023, we're going to see it bump up possibly up to $66,000. With simple IRAs, right now it's $14,000. And an additional $3,000 catch up if you're over the age of 50. Again, in 2023, we're going to see an increase from $14,000 up to $15,500, and the additional catch up will be $3,500. And then, of course, with solo 401ks, you have higher contribution limits. You get to contribute twice, once as worker, once as owner, matches the owner. For 2022, you can possibly put up to $61,000 or $67,500 if you're under the age of 50. Whereas in 2023, we're going to see pretty much, $2,000 plus $2,500 increase in terms of contribution, where you can put in up to $66,000 if you're under the age of 50. And then, of course, with an ESA, the contribution limits will stay the same. So it's going to be $2,000 per year per child. So that's for both 2022 and 2023. And then with an HSA, we do see an increase. But right now for 2022, you can put in $3,650 if you're under the age of 55. For a family plan, you can put in $7,300. If you are 55 or older, you have the additional $1,000. For 2023, for individual plan, it bumps up to $3,850. And then for family plan, it's $7,750. And then again, if you're over the age of 55, you have an additional $1,000 catch up. The process to get started with us is pretty straightforward. Step one, first and foremost, fill out the application. If it's an IRA account, you can do it electronically directly on our website, or we can send you a DocuSign link. If you're looking to open up a solo 401k, the process is a little bit more lengthier. We'll be able to guide you through that regardless. And then, of course, you are paired with a dedicated account manager that's going to be with you for the life of your account with us. And then when it comes to step two is funding your account. So in addition to making an annual cash contribution, as long as you have earned income, you can also do a direct rollover of a former employer plan, like a 401k or 403b. In that scenario, you would have to initiate that request. If you have an existing IRA, whether it's, at your, brokerage firm, you can do a transfer of those funds as many times as you want to or need to. In that scenario, with a transfer, Advanta, as the receiving custodian, would submit that request on your behalf. And then finally, step three is start investing. What is it that you want to invest in? Is it going to be, a crowdfunding deal, or is it, some other real estate related project? And with that, I'll go ahead and turn it over to our speaker, Kaylee. So just bear with me as I make you the presenter.
Well, that's cool. It does a little pop. All right, let me show my slideshow. Thank you so much, everyone who is on this webinar, for coming. I know that your time is precious, but it is important as investors that you stay educated. So what I'd like to do is to give you alternatives not only alternatives for investment as far as opportunities, but also vehicles and things that you may possibly qualify for that you think you don't. That's why we're going over crowdfunding. So typically what we do, and I'll go over a little bit about the basics. I'll go over a little bit about what we do, and then a little bit about a market update, just so that you can kind of figure out what it is that you want to get involved with. It's always good to kind of compare and contrast data of what's going on in the world. There's a few economists that I follow, and a few weekly market updates, or I guess capital markets, that I constantly keep updating our team on. So I'll kind of put all that together, and then of course Q&A at the end. So crowdfunding is a new opportunity for real estate. So this is something that likely has not been seen quite a bit being used, or often being used in real estate. And that was because in 2000 and before 2021, you could only raise $1.07 million maximum with crowdfunding. And so this made more sense for some other smaller opportunities, and we'll cover what you're probably familiar with, or the brands you're familiar with that do crowdfunding. But now as of 2021, it starts to make sense. So we'll go into the basics here. And then, like I said, we'll talk about market. Okay, so a little bit about us. Apartment Queen Investments is the name of our firm. We're an experienced owner-operator team. We have over 72 million assets under management. We are only investing in landlord, business, and tax-friendly states. And we are looking towards big goals for this year of having 200 million assets under management. And what our big goal, big, hairy, audacious goal is to create $1 billion invested by, for, and with women by 2030. So for those of you who like diversity, equity, inclusion, our offerings tend to be something that is attractive to those individuals that like a mission-driven life. So what is crowdfunding? Crowdfunding, like I mentioned, is a new and evolving method of using the internet to raise capital to support a wide range of ideas and ventures. So this became a game changer, like I said, in 21, because after the lockdown and realizing we couldn't go and meet people and raise, we had to have an alternative way to be able to publicly advertise. But then also, how do we reach the average Jane or Joe in America, which, you know, for example, those friends and family offerings, and especially accredited offerings, which is what did exist to be able to raise funds online for real estate, those were only going to apply to accredited investors. And so how do we reach 88% of the remaining U.S. population and even the world? You know, so what is crowdfunding? Going back to this, is an individual or entity raising funds through crowdfunding. And what we're looking for is smaller contributions from a large number of people. And that's why we have the internet, or the interwebs, to be able to advertise this on. Individuals that are interested in the crowdfunding campaign or the offering are members of a crowd or group that may share, we may share information about the project, the cause, the idea, the business, to use the information for those that are looking at it to decide on the collective wisdom of the crowd if they want to invest. So this is something that usually when you see crowdfunding offerings, they usually have a mission behind them. They're not just, hey, we want to make money. Like, you know, that's great and that's good and we should make money, but also we have the ability to do more. So types of crowdfunding that are available out in the universe are donations, reward, debt, and equity funding. Let's go through some examples of brands you're familiar with. So debt-based, for example, crowdfunding, contributors would receive payments in exchange for contributions. So this is, like I mentioned, debt-based. So it's like through the bank. If you've ever seen Moolah Sense, GoFundMe, Crowdo, Fund Here, these are examples of this. Equity-based crowdfunding is when contributors receive shares in exchange for their contributions. That is what we do. So essentially ownership shares is what that means. So if you've seen AngelList, Cedars, FundNull, CapBridge, those are some others that, again, you're not the lender, but you are an equity owner in the project. Physical project. So types of crowdfunding, also these are the last two, reward-based and donations-based. Reward-based, you've probably seen Kickstarter out there, and that's what I was hinting at earlier, or Indiegogo. This is something where contributors will put money in and they will basically be promised rewards in exchange for their support through priority access to the product once it goes live. So these are examples of ones you're probably familiar with when it comes to smaller tech investing, for example, or small startups, pre-seed funds, etc., for, again, smaller startups. And usually those are happening on Indiegogo, Kickstarter. So, you know, you'll usually invest a couple $100 because they're raising, you know, 100,000, you know, max for what they need for their product that they're making, or MVP, minimum viable product. Real estate's a little bit different. So there's also the last one, donations based. If you've ever seen Patreon, That's probably the one I'm the most familiar with. There's also Friend Fund and You Caring. So whether it's a nonprofit that is raising funds for purpose, or like I mentioned, Patreon, if it's for a cause, those are donations based. So essentially all that is charitable and tax deductible, which is fine depending on your tax burden. So regulation crowdfunding is a particular exemption. So if you're familiar with investing in syndications or other types of group funding, you can do a syndicate, you can do basically group investing. There's many ways to do this. And usually those are offered through an exemption. So if you're seeing some of those that are out there in the world, there's Reg A, Reg A Plus, Reg D, Reg CF, and actually Reg F, as in Frank. So we're going to go through Reg CF, crowdfunding. It's an exemption, and that what that means is that it enables eligible companies to offer and sell securities through crowdfunding. Again, securities are basically shares of this company. And when they say securities, I don't know if I define this later, but essentially that is when the individuals who are receiving the benefits of the offering, that they're able to actually own a portion of the deal itself or the offering itself. They have to own a security or a share, and that security is offered through an offeree or, for example, a sponsor like myself, and that has to be registered with the SEC, and then in this situation, also with FINRA. Regulation crowdfunding, it's a lot. It really is one of the most hard types of offerings I've ever done personally because there's so much regulation involved. So on top of this, it doesn't even mention this, but like in Texas, we have TBOC. So you have your Texas Business Code law. So actually that's the first level of law you have to abide by. And then on top of that, then you have crowdfunding law. And on top of that, you have SEC law. So there's multiple layers of vetting of your companies, looking at your past track record, looking at your bank accounts. I don't know if I detailed this later, but having to do an audit of all of your different bank accounts, financials, all of the investments the company has done, the track record, verifying all of this. It's really hard to get qualified to be able to offer a crowdfunding offering or like a Reg A or Reg A Plus because of these things. So the way that a crowdfunding offering usually works is that we have the crowdfunding law regulating how we're offering it. We have to use currently a crowdfunding portal that is regulated and approved by FINRA. So it's on a public.gov website, which are approved. And then once they approve we get approved, then the crowdfunding portal approves us and they want to accept us, then we can offer on their platform. And what we normally do is a launch, and it's called Demo Day. So if you look at our current offering page that we have right now, we actually filmed that demo day because we can't keep having it, all the time, to basically display to those that are interested what we're talking about when we say, hey, here's what we're doing, here's our mission, here's what we're looking to raise, here's how you can get involved. But a demo day is typically when you pitch why this is so important and how to get involved. And the cool thing with regulation crowdfunding is that both non-accredited and accredited investors can invest. Not every crowdfunding offering offers this, but it is a possibility, which is what attracted us to do this. And again, as usual, there's always investment limitations for non-accredited investors because the idea here is to keep that investor from engaging in more risk than is necessary or in an unhealthy level of risk. So, example, you have $100,000 in your savings account and you want to invest 100% of that in a crowdfunding offering, and that's all that you would have, in case things happen in your life. We wouldn't allow that. So we have certain limits, and they're actually pre-regulated by the portal. So I think I already went into this, but essentially, like I mentioned, there's business law, securities law, and crowdfunding law. So some of the rules, like I mentioned, is that the crowdfunding offering has to take place through an SEC-registered intermediary or a platform, either broker-dealer or funding portal. It permits a company to raise a maximum aggregate amount of $5 million through crowdfunding in a 12-month period. So it used to be, like I mentioned, $1,070,000, and so now it's 5x in 2021. And so then it became a viable vehicle to do real estate deals with, because real estate deals, especially these larger commercial deals, require quite a bit of money to raise. So with the current leverage rates right now, like if I wanted to raise $10 million, we're about 50-55% leverage, and so we would have to max out our crowdfund at $5 million, which is what I've set ours at, to be able to go after those assets. And so that, if I wanted to go after something that was worth $10 million, that would have been impossible doing it with the crowdfunding law before 2021. So it's more feasible now. And again, the limit of the individual non-accredited investors that can invest across all crowdfunding offerings in a 12-month period. Again, there is a limit to that. And then also there is an extreme amount of disclosures and information of filings with the commission. So, I mean, like in the past, if anything has ever happened in your life, like you went through a divorce and then you had to file bankruptcy, for example, that is a disclosure that has to be put into this offering. It's very personal. And sometimes we go through things, right? And so that's been fun, but the point is that the investors need to have full disclosure of everything, and it's simply just the truth. So that's okay, but that's a part of, if you are doing a crowdfunding offering, that those must be displayed in the offering. All disclosures of everything. Like, I have brown hair. I'm 5'6". No joke. I have 2 kids. Crowdfunding portal. So like I mentioned earlier, in contrast, a crowdfunding platform is like an online marketplace. That's what we chose instead of going through a broker dealer. So we wanted it to reach an audience that already was involved with mission-driven investing. And so we chose a platform that very much is on the top of tech and then also reaches mission-driven investors. So choosing the platform is an online marketplace where funders or fundraisers can connect with investors to fund their projects independently. So it's democratized. Unlike broker-dealers, crowdfunding portals have a number of limitations to the kinds of activities and service they can perform. I have an entire spreadsheet I put together through the lockdown, and there's probably like 30, 35 platforms on there, and there were only 4 that would actually apply to having experience and the bandwidth to be able to do a real estate offering. Because again, like I mentioned, this is so new, and the ones that did, for the most part, they don't understand commercial real estate. They only understand investing in a single house, how to structure the legal documents to where it would be feasible to do the other. So that's why it has taken us 14 months and 3 attorneys to be able to agree on how we can actually feasibly and legally do our offering to get into multifamily commercial real estate, which is where all the great returns are. And then the more stable returns, because again, if you guys already know this, if you have 10 people leave a 100-unit property of 10% vacancy versus, a 4-unit, and you have, 10 people leave, you're 100% vacant. Bad example, but you see what I'm saying. So this is just an example of a portal, and this is not our crowdfunding portal, but what we would see on the back end as an investor once you log into your portal, once it's live, is that you'd be able to see what offerings are available, and then you'd be able to click on that offering and look at the information. So the information that we have to offer for a crowdfunding offering versus a Regulation D or Delta, we're not doing that one in this example. Regulation CF, instead of having certain, I'm going to use the ones that are appropriate for crowdfunding because the document names all change. So in crowdfunding, you're looking at an operating agreement for the company. You're looking at a term sheet or several term sheets, depending on how many different either companies or share classes there are. And then usually, like I mentioned, this is like the inside of your portal. There's an external page that's going to list all of the documents, the details, what you're getting, where to go invest, and basically a summary of what you're getting. And again, full disclosures are even publicly online. So once again, it's live, then you can register or not register. You can log in with your registration, login and username, and be able to look at, where do I click the button to invest now? That's essentially. Then when you come back into your portal, you'll be able to then see your future documents, like your tax documents. You'll get a K-1, what other investments are also coming available or are available, and then also your dashboard to see where all of the previously signed documents are, current documents, if you want to review anything, or again, like your tax documents. So having a portal is absolutely required when we're doing a crowdfunding offering, as I mentioned before. So this is something that I added to this because I wanted to. I'm not going to go through the whole thing with you, but there's an extra level, like I mentioned, of due diligence that must be done on a crowdfunding offeree. And so this is just one of the 3 financial reviews or audits that we had to go through, and each one costs so much money. It's crazy. This is just all new for me. Normally, like when you do a Regulation D, they don't do any of this stuff. You literally, they check if you're a felon, and then essentially you go to an attorney and they put together an offering that is likely, hopefully fair in the offeree and the investor's favor, but it's up to the investor to do their due diligence at that point and look at all the wording and the documents and negotiate with to basically look out for themselves, so none of this that I'm covering is done on a Regulation D offering. And then again, this is meant to reduce the investor's risk and to make sure that FINRA and SEC is doing more due diligence on the operator. So also I'll let you know that when someone goes through the lengths to do this kind of an offering, you should feel very comfortable with what you're getting involved with instead of being so skeptical, which I believe you should be when you're looking at Reg D. Reg D is interesting where you can, again, just go find an attorney, pay them, they put together documents, and you can raise unlimited funds from just about anybody. If it's a Reg D 506C, they have to be accredited, but unlimited raise, like regardless of how that affects them. And then also when you have a friends and family offering through Reg D, that's something that the investor signs off that they have sufficient knowledge to vet the investment. And in this situation, it does not work that way. In this situation, basically they've done the vetting for you. So this is an example of a financial review. So timeline that we had to run into, what I'm trying to get at here is that it's an extra layer of protection for the investors. It's an extra step, it's an extra cost, and we go through it. And then every time we raise above a certain amount, like for us, it's over $1 million, we have to redo this and redo this. And what they're doing is when you go over $1 million, we have to do a financial audit. This is a review for the first $1 million. But essentially what you're doing is you're looking at all the bank statements, you're looking at all the bank accounts, you're looking at all the transactions, all the investor money that's come in, and making sure that everything balances and actually is accurate. And then when you're saying, hey, I'm investing these funds into this LLC, again, it is checking that is indeed the case. So again, when the next round of funding for an offering, for example, happens, you know that whatever is put publicly out into the public has to be matter of fact, because again, we hired a firm that is non-biased, not internal, they're external, that actually the Fortune 500. Anyway, point is that they do a lot of due diligence for every dollar that's raised. Also, what is now changed as of like 4 weeks ago, we've had to readjust our offerings, is that our new limits have changed. So normally, like I mentioned, it was $1.70 million for the old limit. Now it's $5 million for the new limit. And so now there have been limits as well for the investors that are investing. And so I'm just going to focus on what is current and not past, because this is what matters. And again, if you need this link for the SEC's website, it's /rules, final 2022, et cetera, PDF. And so it'll pull this up and basically show you that thresholds have changed for the home in America because inflation has happened, right? So we can't buy as much as we used to, and that's what happens with inflation. Now, however, once your money is locked up in a deal where you're collecting rent, the inflationary factors actually help us be able to make more on our rent. So it's actually good once it's in a real asset. But here, what I'm trying to show you is that the change has happened where we're able to basically, I'll fast forward here, we can raise between $600,000 and $5 million with financials that have been audited by an independent CPA. I think this might, yes, the threshold limits for investors. This is when you're like, oh, if I want to invest, what is my threshold? Again, the portal that we have enrolled in and we partnered with, this will happen once, again, it's live. So we do a thing right now, and I'll give you guys the link where if you want to get involved with us, if you're wanting to do the crowdfunding offering, or if you're accredited, you can go to another offering. But essentially what it will do is it will get you to register. And then once it is live, after you've registered, you'll get a notification. You'll go in the back end, and essentially this will cap you at how much you can invest. And again, these are the new rules that apply. So just so you know, again, it's meant to keep the investor safe and to make sure that you're not investing more than makes sense. My old rule was 10%, but again, this is just how crowdfunding works. So if a non-accredited investor has an annual income or net worth that is less than $124,000, they may invest the greater of $2,500 all day long, or 5% of the greater of the investor's annual income or net worth. So if your income is more or your net worth is more, you can do 5% of either one of those. Those are all gravy, whatever you're good with. And if a non-accredited investor has an annual income or net worth that is equal to or more than $124,000, they may invest the greater of 10% of the investor's annual income or net worth. And then again, it is not to exceed $124,000. So, if I put a range out there, anyone can invest $2,500. With our offering, we start with $5,000. But basically anyone could in the crowdfunding world, and anyone could invest a maximum of $124,000. So what I'm trying to get at, this number actually used to be smaller before inflation-adjusted rates or limits have been raised. But so even if you make like $1 billion a year as a non-accredited investor, which likely you'd be accredited at that point, but you would be still capped at $124,000. So again, this is meant to keep the risk down for investors. So there's also another level, like I mentioned, of what you have to enroll in as a company that's offering this. And so I want investors on the outside to know this. There's a multi-layered amount of services and, again, basically risk mitigation practices that we have to get involved with to be able to offer these offerings. So we've got to salary or fractional salary a CFO. We need to have a chief financial officer on our team that essentially is doing fund accounting on the fund itself. I won't get into the particulars of the type of method. It's a discounted cash flow method, but that person has to be very well versed at fund accounting, which is very different than all of the other offerings that we have done. And this is in an attempt for us to make sure our asset level financials are correct, so and up to speed, not waiting until the end of the year to file our taxes, making sure month over month we can see the activities. That is then reconciled month over month again, and then quarterly we are putting that together in our book of valuation using, sorry, I kind of already did it, discount cash flow method. So essentially it's like to the minute valuation. So this is something that gives investors that are already invested in this offering or in this, I don't want to call it fund, in this offering, an idea, at least quarterly, of what the shares are worth. You know, not that that matters too much, but I think that investors like to know that. And again, it's all reconciled, so it's accurate, which is, I think, cool. That helps us to have all of this ready for our audits that we have to do. The audits are publicly published. So if you're in the crowdfunding platform, when you're logging in to check on your K-1s, your tax information, you're looking at the documents you've signed, et cetera, the audit information would also be in your portal or in the main area of the portal. Maybe it's not in your account, but point is when you log in, you can then see that information. So again, it's just disclosure. It's just so transparent. This is not something you'll ever find with a Regulation D or Delta offering. Again, like I said, reviewed financials are something that we do on the regular. We also have a rolling close on the way that we do this. And so depending on when you put the money in, that will then predict when you get paid. And it's rolling based on your investment date. And then also a capital call. In this situation, I want to explain to you, a lot of investors, have a negative connotation with capital calls. However, in this sense, when it comes to funds in general, and then when it comes to crowdfunding, the way that we have set up our offering is when you see, and again, you got to read all of this, but when you see the word capital call or call the capital, what you're seeing typically in a rolling close fund or a fund that is acquiring assets as it goes and raising for a certain amount of time, that essentially the investors come in, they put in their commitment, and then when we're ready to call the capital, the investor had already put in 10% of their total investment. And then basically we reach back out to investors and say, okay, now it's time to invest 90% with us. And in the meantime, when investors are waiting to invest the full amount of their commitment, they need to be putting those funds into, say, like a money market account, something that's liquid that they can make some return on, but then also move it over immediately, because that is absolutely required. But, it's not, some investors think it's a negative connotation. It's more, trying to make it to where it's comfortable. So that is a possibility when you are dealing with funds. That's a possibility when you're dealing with crowdfunding or any other kind. Again, these are just things I want you to read and be familiar with and understand. So the funds have different structures and they have different fees. So again, like I mentioned earlier, when you're looking at a crowdfunding offering, you're going to see a thing called a term sheet. And our term sheet is like a swap out for Reg D. Would have a PPM. That's why I didn't want to use the name, because like that goes away. PPM goes away. And it's a term sheet. So the term sheet would identify all the disclosures, all of the previous operating history of the offeree. It would have like disclosures of the market, the risks of the economy. It would tell you everything that we've run into in the past, how we handle those problems. I mean, it's a lot of information. It's taken a long time to get all this articulated. And so I just want to show you an example of our structure, and other structures can be different, where essentially for us, we have crowdfunding investors all out in the universe on the internet, and then they all come together. And for us, again, this is just disclosure of how we set it up. We will have all the investors come into an entity called Verna Fund CF LLC. It is a SPV, so special purpose vehicle. So what that means is because we have the ability to have up to, well, actually between 500 and 1,000 investors, depending on how much they input. I mean, it could be way less than that, but we're just preparing for the worst, meaning that there's a lot of admin expense, there's a lot of time, there's a lot of K1s, there's a lot going on, when you take on that many investors. And also, I'm going to be transparent with you. The way that crowdfunding is set up is that you as an investor are going through the portal. You are not contacting your sponsor. So we have the ability for those that invest above. For us, every offeree has their own way they do things. But if we're going to take smaller amounts than 25,000, then we need our investors just to focus on getting their information from the portal and not emailing and texting and calling the sponsors who must stay focused on operations. But those that are investing more, that want to maybe learn more or get more involved in the future and say, I'm going to double my investment every time I invest with you, then there's a different relationship set up there. But the point is that this SPV, or special purpose vehicle, what it's meant to do is take those 500, hopefully, or less investors, and a cap table or capitalization table is the list of all the investors that we have in our deal or in our LLC, for example. And so the SPV shrinks like 500 investors down to one entity. This is that entity. And then we have a manager group that is ours, that is the operator of that. Now, there's no way that we could get a loan if we didn't do it like this. I just want to let you guys know that it has nothing to do. The lender needs to know that there is a one decision maker that they deal with and that they go to. That is very important. And again, we would not qualify for agency debt, which is Fannie, Freddie, or other debt vehicles that we need to use to be able to purchase these properties. So for us, that LLC, like I mentioned, with all the investors in it, shrinks down to one SPV. And then it is a Reg CF issuer is what it's called. And then that issuer issue shares, right? And then that bunch of us invest into the real property. That is the absolute required. That is absolutely required of a crowdfunding offering. And so it's just a little bit different than normal. So whether you're listening to this as I want to do this as an investor, I want to set one up. By the way, y'all, I teach a full set of classes that I recorded that I do weekly and have in a portal for you as well if you're wanting to do this yourself and offer this, because there's so many pitfalls and things that we've been through where people, take advantage of someone who's new at this, attorneys, all kinds of things. And so I've created guides and legal docs and all things to get through this. But point is that one of the things is that in crowdfunding, the funds and the equity shareholders have to invest directly into the asset. Whereas if you do a Reg D or some other different kinds of funds, they can invest as a fund of funds. So they can invest your funds into another person's fund all day long. They can invest your funds, and essentially it's an investment company is what it's termed as. Investment companies cannot invest in or cannot be a crowdfund offering. They have to invest directly into the real estate. So sometimes people kind of get confused about that and they don't understand. You would have, multiple investors, but all those investors have to go into the asset if you're non-accredited, because that's how we're taking those through crowdfunding as the non-accredited investors. So rules for advertising, again, I'm not going to open this. This is part of the class I taught for those that want to actually do this as an offeree. There's a whole new set of rules for how we can actually do our ads, do our copy, and keep track of everything that's been put out into, I love using the word universe, obviously, to talk about what you're offering. So there's different levels of what you can talk about and can't talk about, disclosures, again, that you have to give at the bottom of all of your advertisements. You have to be very careful, even in like your email copy, as to what you can talk about. But usually, like to summarize Rule 206, essentially your copy either has to be talking about the mission and the purpose of the offering that you're getting involved in and what we've done in the past. So it's more like a qualitative, or there's like a quant or quantitative type of offering post that you can do where it's more about here's the projected returns, here's our past performance, more numbers driven. So, but you can't do them together. And every single time when you have information that goes out into the universe via Rule 206, when we're doing, it's called test the waters, we have to keep copy of every single like Facebook post, video, website, and put it into one document where we're tracking it. And this is tracking what's going out there, again, before that offering is live. So there's a lot of rules when it comes to this kind of offering. And again, if you were wanting to do this yourself, I teach this in another class. If you want to create good copy, which is so important to be able to speak to that mission-driven investor who really cares about what you're doing, You have to have the same copy and consistently have a landing page that makes sense to 88% of the United States population. So it's got to be technical, but a little bit more generally understood. And then also same thing with your ad. You have to have all these things set up. And again, having someone help you with your copy. I mean, we paid over $4,000 for just the copy. Then the landing page. Then I hope you can't see that on my screen, so I get notifications. All this, there's a lot to it, so it's ads, your landing page, your copy. These are just layers of things that you have to have. And again, they have to all be compliant. So whether it's your attorney or whether, I simply just read the rule, you know what I mean? It seems complicated, but if you just break it down, then you know what to follow. But, and then if your team, for example, if you have people on your team, you had 10 at one point, working on putting this out in ad form, etc., they all have to also be compliant. So it's just something that you've got to be really cognizant of what's going out there. Now, I do want to cover what is an accredited investor, because that definition also changed in 21. So if you're out of the loop for a while, I'm happy to add this to your vernacular of what this means. The definition expanded, and which that is good, because that means an additional 12% of American households became accredited, which is cool. So why this is important to talk about is because with an accredited investor, the way that we're doing our offerings right now is we have two offerings. We have one that is a Regulation D offering. We use a platform called InvestNext that investors go through that vehicle. So we'll talk about who qualifies for that. Then we have a crowdfunding vehicle, as we've covered in this presentation, which currently we are pre-launch, and we are doing TTW, or test the waters, as I mentioned, where we talk about what is available. And then essentially, as soon as the launch period is over and we actually have the offering available at the end of this year, then you'll be able to actually, click the button to actually invest. But we have to drum up all of the commitments before. That's just kind of how it works. And then, call the capital when it's time. So an accredited investor is a bank, savings, or loan association, an insurance company, a registered investment company, business development company, or small business, or a rural business investment company. A SEC regulated broker dealer, as I mentioned before, that we can work with. That is basically, by the way, your highest level of any kind of financial advisor, quote unquote, is a registered broker dealer. They invest themselves. They have multiple degrees. They're people that know and practice what they preach, just FYI. But also, they're considered accredited. So is a investment advisor that's, again, SEC registered, and also an exempt reporting advisor, a charitable organization, corp, limited liability company, partnership with assets over $5 million. Also, a plan, this is cool, established and maintained by a state political subdivision, agency, or any political subdivision for the benefit of its employees. So usually that's like a pension fund example, insurance company example, that has a plan that is in total assets over $5 million. Here's another, this is cool. A director, executive officer, general partner of a company selling securities. So if you're part of a real estate investment company, or someone selling securities, or if you're a director of, executive officer, general partner, general counsel, if you're a fund employee, essentially, you're accredited. An individual with a net worth or joint family net worth of a spouse, or this is a new change, or a spousal equivalent, so it doesn't have to be a married spouse. We've changed a little bit. In that situation, if you have at least $1 million, again, not including the value of your primary residence, so you subtract that out. But again, that expanded. An individual with an income over $200K for the most recent 2 years, or a spousal couple or a spousal equivalent, like I mentioned, exceeding $300,000 for 2 years. Those are also considered accredited. A trust, so any family trust with assets over $5 million. And again, that trust couldn't be formed primarily only to acquire securities, and is directed by a person who meets legal standards of sufficient knowledge and experience. And then this isn't on here, but I'm going to get this wrong. Also, an investment advisor, so a financial advisor that has their series 657283 license, and they're active in those licenses, boom, they're also considered accredited. So this just like super expanded. So there's a lot more people that are accredited, even if you didn't think you were. So point is, these accredited investors can pretty much invest into anything. And the way that we're doing it is we're doing it through a 506C offering. Okay, so I'm just going to throw this out there just so you know. We also have started to take all the stuff that's in my brain and offer classes every week so that you can actually enroll in becoming a savvy investor by learning from our lessons. And so this is just whether it's legal strategy, whether it's investment strategy, fundraising strategy, security strategy. There's so much that we've had to create to be able to keep, I call it fortress strategy, to be able to keep our castle secure. So we're now offering that weekly. And so if you'd like more information, I'm happy to give you my email after this. So this is typical, not always the same. So for example, whether it's crowdfunding or whether it's Regulation D, typically they're looking for limited partners to invest $100,000. And then again, the angel seed capital doesn't really apply to this presentation, but typically they're looking for about 100,000. Now that's been what we've been looking for an accredited offering. But like I mentioned, the way that we're doing it is that we're doing crowdfunding for all those who are not accredited. And so we've actually changed our our minimum to 1/10 of the industry average. So the industry average investment for any kind of alternative investment is typically about $50,000, typically always the minimum. And so we have lowered that to 1/10 of that. So again, this is for those of you like me, when you got into the world of alternative investments, you wanted to get going, when I was 22 and I didn't have very much money. I didn't have a, stout retirement account. And so I ended up taking a small retirement account I had and being able to invest in a non-correctly legally structured investment, but it still produces 8% per month. And that's why I mentioned all these things about securities. Any investment where the investors are looking for a professional sponsor or advisor that is in charge of the investment to provide them a benefit without them actively being involved, and there's more than 2 people, it's considered a security. So this is something that basically, just hopefully you guys can still hear me. Sorry, I got a call. This is just something that, again, is just changed with crowdfunding. So not all offerees are going to do this, but like I said, typically it's 100K. The industry average is 50K. And then what we've done is we've sliced that minimum way down. And so typically they're like, what are you using this capital for, Kaylee and others? So it's for marketing, it's for educational events to get investors to invest in this property or in the offering itself, whether it's several properties or one, earnest money deposit on the property, feasibility costs, legal fees, and there are many other soft costs when it comes to acquisition of the investments themselves or the properties themselves. So essentially, what we wanted to offer you, I did send this in the chat, is the ability to be able to get qualified for our offerings. So we're already rolling with our offerings now. And like I mentioned before, how it's working is that if you're an accredited investor, your offering is already live. And so there is a link that I put in the chat earlier. I can't send it to everyone, but I'm hoping I can have some help there, where essentially go back to that, sorry. Where essentially you'll go to this landing page and it's for the fund. And again, there's 2 offerings. There's a pop-up window that will come up and there's 2 buttons. And I just went through for everybody what an accredited investor is. So you're probably marking down, yes, I am. No, I'm not. If you are accredited, you just click the accredited button on that pop-up. If you're everybody else who didn't qualify for all those things I mentioned, you are then not accredited or non-qualified. But again, it's okay because then that's where you go is the crowdfunding offering. So then you click the other button, non-accredited. And so depending on the button you choose, that will send you to the correct portal that is going to offer or hold your investment, your document, all the communication, your communication preferences, etc. Then all you do is just commit to how much you'd like to invest. And like I mentioned, on the crowdfunding offering, we're doing test the waters right now. And so to be able to save your equity position in that deal, because again, we have a limit with how many non-accredited investors we can take there. That one is one that you'd want to basically put in your soft commitment and then notate how much you're looking to invest and notate what kind of account that you're looking to invest with. Because again, we can take IRAs, retirement accounts, so that they're not sitting around. Because every day that you're not investing it in something is either appreciation or cash flow or both, and then also tax advantages that will help to offset your other active income taxes that you're just missing out on. So there's no reason to let it sit around. So yeah, like I mentioned, we'll send out that link and it's going to be coming to you in the chat, and it's /fund/ the last word. And so you'll just click the button accredited or non-accredited and make your commitment in the appropriate portals. There's copious amounts of information, investment documents, what you get, share class numbers, all the things that you need to know that are on those landing pages, or on that landing page and your separate portal pages. So if you have any questions, of course, through the website, there's a contact form for us that, we can explain more to you. And again, if you'd like to email me, that's probably the most efficient way to get a hold of us, whether you need that information or not. I'm going to give you a different phone number than you see here. It's our office line. And so that's the one that you can actually text to get to the right place. So if you take this number down, 214-699-8810, and you text accredited or not accredited, depending on what we learned earlier, then I can just simply send you the link that you need to go to make it super clear. So we have it on the landing page, and then I can also just, text it to you from our work phone. So either way, that is how to get a hold of us. We're located here in Dallas, Texas. And now that we've sold our last asset in Phoenix, Arizona, by the way, at a 3.69 equity multiple. So our investors that put in 100K got 370 back. Sorry, it's awesome. Now, since that sale has happened, we are only in Texas. So I'm located here in Texas. That stay that way so that we stay local. Let's see. And I can go over a quick market update, Reneika, if you'd like, or do you want me to take off my screen to do it?
Yes, I do have a couple questions that's coming in, so you can feel free to provide any additional insight, but I do want to, before we open up the questions, this webinar is recorded. It will be on our YouTube channel within 24 to 48 hours. And also too, you'll get an email with that link to the recording. A question that came up is, just bear with me one moment. It's more so a statement for IRAs. Does your IRA money count towards your the network? So yes, the value of your 401k or IRA is part of your network and should be included or able to be included in terms of when you're calculating your network. So to answer that related questions, let's see. Let me just go ahead and, so the question is, what is the average ROI and do I receive monthly dividends? Is the question that came in.
Sure. So if you go to the, I mentioned, it's theapartmentqueen.com / it's in the chat, and I think that can be sent to you. Reneika, is that possible to send that?
So unfortunately, I'm unable to send, but however, if you do want a copy of the slides, Kayla, I know you're going to provide me the link to the actual slide. I can also include the link to these two. If someone reaches out directly to request it, I can include those two links, but I'm not able to send it directly to the group.
Okay, so those two links, one is to go to the fund page where it explains all of this. So it's going to be theapartmentqueen.com FUND fund / or if you go to theapartmentqueen.com and go up into the top, number one female focused apartment fund, it'll pop right up for you. So that will actually explain everything in each share class and each investor, if you're accredited or whether you're not, or a ton of money or less. We really wanted this to be equitable to everybody, so it's the same for everybody. But to answer your question directly, the fund will be returning a cash-on-cash, annualized cash of 13% cash-on-cash for investors. That is annualized, and the way that we do this fund, just like we have every other investment we've done, is like I mentioned in this case, the sooner that you're able to invest, that starts the time clock as to when your payout starts. So we have been buying assets that revolve around some kind of value add. So we have to do construction, we have to get rid of the non-paying residents, we have to lease up again, we have to change and fix the business. And so we give ourselves a 1-year runway to do so. So once you invest, you get a 1-year runway to start your dividends, and those will come out quarterly. So we pay out cash quarterly. And then, of course, on any kind of capital event like a refinance, cash out, a sale, that will give you also an additional and or final amount of payment back to you, so 100% of plus. So you'll get that cash on cash for quarter after year one, and then also the fund will be targeting to get investors a minimum of 1.75 equity multiple. Now, we've got a couple of deals in the fund now that are much higher than that, so like a 2.9x, one's a 2x, but we always want to under-promise and over-deliver. So if you want more information about that and all the offering documents, it's just theapartmentqueen.com /fund /FUND. And then what is the other question?
Okay, so the other question is the annual income for the new inflation adjusted raise limits the same as the adjusted gross income?
Is the
So
annual new, say again?
is the annual income for new inflation adjusted raise limits, the chart that you were showing, is it the same as adjusted gross income?
Yes. Thank you for clarifying.
Okay.
Yes.
All right, so next question is, just bear with me one moment. I know you have an additional document you want to share too, but I just want to get to the questions. What is the average hold time for these investments?
Yes. So it's also on that fund page. So again, theapartmentqueen.com/fund/. All of the information is there. The projected hold time is 5 to 7 years. When you actually, again, recommend you actually read the offering document, there is the ability, so it's 5 years is the projected. So I'll say 5 to 7, but it says 5. And when I say 7, that's because right now the market changing and knowing if something happens to where our cap rate doesn't go down or compress at all. I don't want to get too much of the details, but essentially it's 5 years, and we have the ability, depending on what's happening with the market, to do a total of 7. So our investors that are investing with us, they understand that they don't want to lose money. They want to be able to retain any kind of funds that they have made through investments, and so sinking it into a real asset is the way to do that. So they're okay with a long-term hold and being more patient with their capital as the market.
Okay, next question that came up, just bear with me. It's actually two questions. So you mentioned, I'll do the acronym BHAG. Are you familiar with DLP Capital and Don Weiner? He uses that same phrase as well. And then the second question is, are you able to pencil out the deals with the long-term rate being 7+%?
Okay, so I couldn't hear the acronym. It said
BHAG. Are you familiar? Are you familiar with a person? DLP Capital, Don Weiner is the person that they're asking if you're familiar with them. And then, of course, are you able to pencil out deals with long-term rates being 7+ with interest rates going up?
Second question, yes. Question, I think you said B as in boy, BHAG.
No, D as in David. Don, are you familiar with him? He's an investment provider as well. DLP Capital, are you familiar with that?
I'm not. Wayne or I have definitely heard of that property management company that we'd never actually had hired there now.
Okay. So the second question, are you able to pencil out deals with long-term rates being 7% or higher?
Yes, and like I mentioned, that's why our cash-on-cash estimate is set to 13%. Now, I don't think that we're going to be getting that 13%, that's for sure, and we've had to be really selective with our deals, actually partner with other women, because normally I could hunt and find something, and now it's so hard to find that 9% of what's available off market at this point. So we've got to partner up with other yes, or otherwise we just don't invest in the property. So we've had very few.
Okay, and I know you wanted to share like a report. Feel free to do so. If you have additional questions, enter those in the question box.
Yeah. So I just want to share with y'all a little bit of a market update on what we're seeing out there in the world, because it's important to understand where we're getting our data and what we're dealing with and what has happened. So I do want to share with you that if you're not in DFW or if you're not in the United States, that DFW actually, DFW through 2010 through 2020 had a greater population growth than 47 states. So put that in your back pocket. So that's obviously when we're looking to invest in DFW. We also know that Texas, so if we're looking to invest in Texas, which is where we're investing now, that they have 53 or more Fortune 500 companies than any state. We have a few more that have announced that thing here, so that's obviously really great for population growth metrics. Not all of them are moving. Some are moving to Austin. Some are moving to Houston. To other smaller places kind of outside of Austin, for example. So that's another great thing, is you want to for sure see that population growth, income growth, home value growth, crime decrease happening wherever it is. And again, we just invest with our fund offerings and our other offerings as well. And then what we're looking to see is about 16% population growth through 2029. Not saying that that is how we're underwriting. We're not doing our financial analysis. We are simply keeping up with inflation. But check this out. So here's another thing that we have run into, and hence why we have changed our investment strategy a little bit. So what we're seeing, and it's so crazy, is that inflation rate is around 2%, like around, could be a little less, a little more. Labor has increased to 5%, and it's going to continue to increase till 2025, or at least it's predicted. Again, this is coming from some economists that I follow. So labor, what I'm trying to say, is outpacing inflation. So labor has become more expensive than we ever could have predicted. And I'm sure you guys, if you're in a certain business where you're hiring laborers, or you're partnering with those that are in construction, for example, you're seeing this as well. But that's also caused a challenge when it comes to even like C-suite executives, for example, not just labor. Hiring has been incredible. And then we've dealt with a lot. So that's going to only continue to get based on a few reasons. So if we're looking at properties, we're looking more for properties that are like 1982, closer to 1990 vintage or build, because we know that we are not going to have or need all of that labor to be able to do the renovations that we normally have been okay with doing. We've been okay with saying, oh yeah, it needs a new roof. Oh yeah, it's siding, that's fine. But now with labor shortages, and really more so labor costs, it doesn't really make sense to be able to also get our investors the return. So we've got to be a little smarter in what we're investing in. So that's what we're doing. And then also I want you to know that, for example, if you're looking at how large Texas is and how population has become, Texas makes up 9 to 10% entire United States, United States population. So, did I get that right? Yes, I got that right. So that's a pretty decent chunk. And obviously, you know that there's others like New York and LA that have a large concentration in one area. And then here's another fact that I want you to think about, because you're probably dealing with it too, whether it's your family members or you, is that right now, as of ago, are $4 trillion sitting in Americans' checking accounts making no money, literally no money, and that doesn't make sense. And so, I mean, we're highly liquid, but people are taking a pause. But again, you have money sitting there not making any return, that doesn't even make sense. And that's not even in like money market accounts, that's in just checking. So, I mean, minimum, get it into a money market, and better so to be able to save yourself on taxes and be able to have control of funds. Because again, inflation is happening, would be to be able to put it into a solid asset. It doesn't even have to be real estate, y'all. I mean, you can invest in a cannabis farm. You can go invest in land and dirt. You can go invest in gold. You can invest any physical asset. I mean, seriously, time to put your money in there. You checking, knock it off. Like, take your enough to live off of for 18 months, because what I'm seeing based on a few things, 18 months, we're going to see a big shift in everything, in the real estate economy, but also normal, like the entire economy. And with inflation being the way that it is, all that's going to do is devalue the money that you have that's not in a safe, secure vehicle. So just take that into account. Stop letting money sit around in your checking account on it. And then we're going to see a lot of automation changes happening to be able to act this labor problem that we're having, that again is get worse because the policy that we've had is not. And I don't know who the next president's going to be, and I'm not political, but we don't know, who is going to control our borders being completely shut down. Are we going to be able to have affordable labor? No. Are we going to be able to ship overseas labor? No. Do we have connections with China anymore? No. Do we, so all that does is increase this problem of having labor being more inaccessible and more expensive. So automation has got to come in. So essentially, that's another part of our business that we're exploring, but it will take time. And then I want to let you know that if you look up, and this was, again, 2.5 weeks ago or so, there was what we call like a Lehman moment. So before the crash that we had a long time ago, there was a moment, where Lehman was showing that essentially that what was going to transpire was happening. And so only a few people were able to recognize it and act on that. But right now, 2.5 weeks ago, England, they have pension funds in England. They have a large pension fund there. I forget the name of it because I can't read my writing. It's like DIYER or DIVER. But point is they have a pension fund that showed a lean moment, if you will, where essentially it became negative. So it was no longer profitable, and they're trying to move their funds out of England to America. So we have not had it yet, but when we did, like I said, this quote Lehman moment for us, it was watching a large stock, a large public company, we'll just call it that, AIG, was one of your best indicators of the behavior of their assets and what's happening with their assets under management. That would be kind of like this first thing that you're going to see when we see like a quote Lehman moment. And again, I don't believe that what we're going to experience is the same, because we have other things now, like I mentioned, such as automation, artificial intelligence, and I'm also noticing the extreme amount of resistance and pushback in the commercial real estate industry to those things. And so for those of us who are open to that and are making strides to go back to school, for example, and be able to add this to our business, we're the ones that are going to be able to survive no matter what's happening with the economy and what I just explained. So that's just a little glimpse. I would really go check out an economist, Dr. Mark Dotzer. I went to Texas A&M and he's a professor there. He actually is going to start in 2023. But he has a very good way of explaining what we're seeing now, for example, with defunding oil and gas, with our trade with China, et cetera, and how that's going to affect everything that we're doing. And he has these reports that he does on his website. So if you go to Texas A&M Real Estate Center and go look up Dr. Mark, you can find more information about up-to-date statistics such as I just shared. Good, bad, different, or the other, and I would go check it out before, again, he goes dark and retires in 2023. So that's a lot of information. And again, if you want to email me, I'm happy to send you these two links. My email is on the screen right now. It's admin, ADMIN. Actually, it's not on there. Sorry. My email is admin, ADMIN, THE, apartment, APARTMENT, queen, QUEEN.com. I can send you the link for the fund, which again is queen.com/fund, and that will help you to decide based on the buttons at the top where an accredited investor would go, where a non-accredited investor would go. And the last thing I want to leave you with is I've noticed that making through quite a bit in my career, again, whether it's legal, whether it's fortress strategy, safety and security data, we even talk to our investors on an encrypted server. There's so many things that we do that are a little bit different based on hard lessons we've learned. And so I've started to investors and those that want to become a deal sponsor or already are and want to tighten up their operations or be really good at protecting their investors. And that's something that we also want to email me about those weekly classes that we offer. That's something else we can do. We want to pride ourselves on educated audience, educated investors, and obviously making sure that you have offerings and opportunities to invest in.
Wonderful. Thank you so much, Kaylee. Great information as always. I do have one final question if you're able to before I know we're just a little over, so just bear with me.
Yeah.
The question is, what class of multifamily do you invest in?
Yeah, so right now we've changed our strategy where I would say, based on that vintage I mentioned earlier, I would classify that potentially B- or B+, right in that range. So really find something that's B-, bring it up to B+, right in the B's. Yeah, as of today, yes.
Wonderful. Great content, great questions, everyone. If you have any specific questions or need further guidance when it comes to self-direction, definitely feel free to reach out to me. You can give me a call, send me an email, visit AdvantaIRA.com. Obviously, if you want to know more about the Apartment Queen, feel free to reach out to Kaylee, and happy investing, everyone.
Yeah, and y'all get your money out of your freaking checking account. Thank you for listening.
Absolutely. Have a great one.